Good morning and welcome to the Orlando Real Estate Buzz. I'm Brendan Rendo with the Homes in Orlando team and joined as always by Joseph Dion of Apley Home Loans. So we got some fresh numbers this morning.
Fresh
On the jobless claims. Got that going. We've seen maybe some settlement in the market that it is what it is. All right.
Maybe.
And then some interesting look at where consumers see things going and where some people in the industry see things going. Kind of a contradiction there. You know what I mean?
Mm-hmm.
So let's hop right in and hop right into our jobless claims this morning. We took a little spike.
Just a small one. I mean, it's small.
Yeah, about 10% over last week. And the market wasn't expecting this.
No.
But what's interesting is you would think with people being laid off, employment going up, the market would go down a little bit, right?
Not this market.
They were like, yes, people got laid off. People got laid off.
Yeah. So, like that's the key, right? Like, people got laid off more than expected. So like, we're going to get what? Like, that probably means that it's more likely that we might get a rate cut. So let's celebrate.
Yes.
And let's drive up everything.
Yep. I mean, when you look at it, here's the chart since June of last year, and you see we took some dramatic dips going through January, but really since January, kind of even. I mean, it's interesting how like 3, 4, 5, 6 weeks roughly in a row, it was the exact same number. It's amazing how that happens. Yeah. And then we hit our spike. But I think we've both been wondering why the claim's been so low the past couple of weeks.
Yep.
When you're talking to people out there and it's like, well, my friend so-and-so just got laid off. This person just got laid off. Talking to a client of mine who prepares taxes, and well, number of her clients just got laid off. You've seen it in the news, major layoffs coming. It's just, why is it taking so long to hit the numbers is what I'm curious. Is because, severance, it took a couple months for the severance packages to basically go away. And now they're actually making their unemployment claims, just
maybe,
but overall in the market, it just kind of stock-wise, the stock market liked it. But it really, interesting enough, when we get back into our Fed watch, it didn't move anything this morning.
No.
Didn't move anything this morning. So people are still, really 91%, a little over 91%. Still aren't thinking that we're going to get the June rate cut. We hop into July, and we're still about 67%. So, you got a good portion, roughly about 30% of the people thinking that they may cut it in July, which I think it would depend. I don't know what the number is that we have to see unemployment-wise for the Fed to say, oh, maybe we need to do this a little quicker than we thought we had to do it.
I don't know. I almost sense like, I think the Fed's going to hold put for a little bit.
Yeah, I think Jerome actually likes seeing a little bit of pain.
I think so.
Because when you look at the numbers, it's like, and that it takes time for it to get into the system. If he doesn't feel like we need more pain, I think they might have done the quarter point and just held it.
Yeah.
Just kind of held it. But, we still got the market really pricing in the rate cut in September this year. But I think you and I are agreeing more with this headline, which is there's more hints that the Fed might not cut rates at all this year.
Yeah.
I think unless the economy really takes a dive before the election, and they need to boost something to keep Jose, try and keep Jose in office. I think they may hold it through the rest of the year.
I don't know. I still am a firm believer. Like I still think we're gonna get one before the election. I still think so.
Yeah. So you're kind of in that. Well, it would have to be in September then. We'd have to have that September rate cut.
That's what I kind of feel is going to happen.
But I mean, 1/4 point rate cut, is it going to be enough to bolster anything that soon before the election? I don't think so. Maybe mentally it'll help people.
But let's talk about it. Like, what is the market doing just off of the idea that they might get a rate cut?
Oh, they're blowing through the roof.
I think if we actually got the rate cut, it would be euphoria around here.
Oh my gosh, we'd probably gain 500 points on the Dow, in overnight. Then what? The S&P,
best market, all-time highs. Like, I mean, we basically living at all-time highs.
That would be the headlines. Even though when you sit and you look at the earnings that have been coming out, the earnings have been horrendous.
Yeah,
and the ones that are getting hurt the most are, for instance, the restaurant, the what I would call the mid to lower end restaurants. Was it Denny's came out? They got destroyed. I think their profitability was down like 36% in their earnings that they reported. Their earnings were only down like 3.6, but their actual profitability was down like 36%. Okay. Which means that they're trying to hold their prices. Their margins are getting just cut tremendously.
Well, inflation, everything costs more, but they're trying to keep price. They're trying not to raise prices because they know their base.
Yeah, they know their base, and that base is just, I'm telling you, bananas has gone up, man. The bananas have gone up, Joe.
I mean, it's hard knock. Like, have you gotten to McDonald's or like? I mean, a family can't even afford Chick-fil-A anymore. Like,
oh my gosh, we stopped. We stopped. 4 of us going.
Oh my gosh, what are you talking about? I've got 3 kids and none of them order kids meals anymore. I went from like barely affordable to like, gosh, is this fine dining over here?
Are you putting gas in the truck today, huh?
I mean, Lord's Chicken, like, whew. It really did a number on the wallet. So, no, but it's interesting with a lot of what we're seeing here because, we see a lot of speculation. We see a lot of this. We see a lot of the market. Like we've kind of gone away from a fundamental based market in a lot you really and have. Then what is it going to do for like mortgage-backed securities and interest rates? And on our side, like what we do day in and day out, it's like you take the news that we got, right? Unemployment numbers go up. Stock market loves it, right? Which means that, well, let's see. MBS. Well, let's see. Right now, MBS is down. That's good.
Okay.
10 years up 1 bip. MBS is down 11 bips right now for the morning.
Okay. But we've seen over the past couple of weeks is we've pushed up.
Mm-hmm.
But it's going to be interesting when we get into the numbers because I think people finally said hell with it. I think that's where we're at in the market is hell with it. This is where we're going to be.
Yep.
I'm tired of waiting. And it's interesting because we were having a discussion about a call you've got to be on here very shortly. But this is from yesterday. Gallup comes out every year with their expectations of home prices. And Americans expect home prices to rise.
Woo-hoo.
68% of people are predicting home price increases. And logically, it doesn't make sense to me. It kind of does because inflation, right?
Mm-hmm.
It's because continued inflation. But when you look at affordability, it makes no sense whatsoever. Makes absolutely no sense. And this is the hardest part right here. If you're a seller, you got to realize right now, only 21% say it's a good time to buy. And 76 say it's a bad time to buy a house. So we have got more people sitting on the sidelines than ever before.
I'm just really impressed for the 3% that's like, 3% of America doesn't have an opinion. There we go.
No idea. No idea. And you look at it graphically, and it's just, we took a dip where people thought, prices may increase, but 68%. And I'm thinking, okay, when I look at builder prices right now, they're not going up. They're cutting prices several places. The initiatives the incentives are absolutely tremendous all over the place. Then you look at the number of price cuts that are happening, when on average about 30 to 35% of the MLS in the Orlando area is cutting prices.
Yeah.
It doesn't match up with it.
So what are we missing?
Fundamentals again. Fundamentals. I think people are missing fundamentals. When you actually put pen to paper and you see what your payment's going to be, I think that's what people are missing. Is that we've just hit that point where you can't stretch it any farther. You can't stretch prices any farther.
Yeah.
I think the builders figure that out as well.
Yeah.
Because builders over the past year have started to shrink the size of their houses. They're building smaller houses.
I like that. That means they're building more affordable housing, right?
What?
Oh, okay. Never mind. Sorry. We're going somewhere else with this. Never mind. So we're not getting more affordable house.
We're not actually getting more affordable.
We're talking what, like 100, 200 square feet smaller?
Roughly about 200 square feet. So you figure it's costing them roughly, say, $150 a square foot.
Yep.
Okay, so 200. We're at what foot? They're cutting about $6,000 worth of expenses off their houses.
Yep.
Where's that $6,000 going? To pay for what? The incentives.
Wait a minute.
They're putting out all these incentives for the houses, the buy downs, which the cost to buy a package down.
Astronomical, right?
Astronomical. Yep. So if I'm giving it away over here, I've got to cut it someplace over there.
Yep.
So where are they going to cut it? They're going to shrink the size of the houses.
Bingo.
That's why they're doing it. Economics, profitability. That's why they're doing it. So, and then I just saw this one this morning, and I was kind of laughing because we've never heard of a soft landing, have we?
Never. Soft landing. What is that?
Yeah. I was trying to find a plane crash this morning for the opening. I thought it would be very appropriate. But I agree with it wholeheartedly. Is, I still think we're in for a hard landing. And, when they're talking about productivity numbers, and when you read through the article and you see the productivity numbers are just dwindling tremendously, that even one rate cut, two rate cuts, even if they did it right now, I think we'd still be in for a pretty big hard landing, especially when you look at all the consumer numbers of where they're at right now.
Well, I mean,
delinquencies in cars.
Delinquency in cars are up. What was really interesting, Harris Poll just put out an article and they're on a recent poll that they did on the buy now, pay later programs, right?
Yes.
And it was because that's one of the hardest things to track because it's not on the credit report. It's not
right.
But if you notice, like earnings came out, Affirm, horrible earnings. You got Klarna, like you got all these different buy now, pay now. But what's interesting about it was the amount of people, and I don't have the report up, but it was something like 40% of people were delinquent or behind on those payments.
Yep.
And then when it polled, because what do we automatically assume? Buy now, pay later. Who is that for?
Lower income people.
And it said that over 50%, the Harris poll said that over 50% polled made over 100,000 in their household. That's not lower income people.
No.
And why? And then when asked why did they do buy now, pay later, it was over. I want to say it was like, and I could be wrong, but it was something like 70% said that it was because they had maxed out credit cards. They had this, and it was their only option.
Mm-hmm.
And then they went on to say that a significant portion of people, and I won't say the percentage because I don't, were utilizing or considering utilizing buy now, pay later for essential items, including groceries.
Yep.
And have you noticed, like I noticed this the other day, like when you order like Walmart, like you go to Walmart or the grocery store, like you have this option now.
Yeah.
And I've never thought about, like, I was like, wow, like that to me was a massive red flag of where is consumer confidence at? Where is consumer spending going? That's a concern because it's been high. I think this is what's been holding off the recession numbers. Like over 26% of the GDP has been going toward spending, has been spending, right? The government's spending at a high level, consumer spending is at a high level. And when you evaluate it, it's like, well, consumer went through all their stimulus savings. That's all gone. Reported gone. Everybody's gone through stimulus savings. Then you go into credit cards. Well, credit cards at an all-time high. Max debt, like credit card debt is at an all-time high. Interest rates for credit cards are at an all-time high, so people can't pay down those balances as full. And then credit card spending is declining because nobody has the ability to spend, right?
Yeah, there's nothing left on them.
So now you got the buy now, pay later, but those are going into like a large portion and go like, what is that saying? It's America doesn't have money. Well, it says that the American people have a spending problem probably, but I'm sorry that we keep following Papa government on their spending. What do they expect? Government just prints money, and then I guess the American people think we could do the same, but we can't. Maybe the government's going to come back and give us more stimulus checks. I don't know. Maybe they'll waive credit card. Maybe you can get. I'm sure somebody would be offended though if they got rid of credit card debt for everybody. I'm not sure who, but somebody would be. I probably would be. But with that, you look at the different pieces and it's like, okay, well, where are we going? Over 70% of our GDP is controlled to consumer spending, meaning that consumer spending has a direct impact on over 70% of our GDP. So if consumer spending goes down, what's that going to do to our economy? That means for every 1% of consumer spending, potentially 0.7% of our GDP decreases. So what if we see a 5 or 10% drop in consumer spending?
We're crushed. We're crushed.
Do we get that soft landing?
I think that's called crash and burn.
It might be.
I think that one is the crash and burn.
And that's what I'm seeing right now. Like I don't see a way around. Like I think we've seen the cracks in the armor, cracks in the shield, whatever you want to say, and it's gonna get worse. Like, I don't know how long we can keep putting duct tape on our shield.
We've hit the limit on everything.
Yeah.
We've hit the limit on everything. And you've got Jamie Dimon coming out. You've got others coming out saying, hey, government, quit the spending. Stop it. And then you get people all excited because Yellen comes out and says, oh, well, this quarter we were expecting to spend, or we're expecting to borrow $253 billion. But you know what? We're only going to borrow $243 billion. Yeah. At what? They're doing it all short term. So all of the interest on the government debt is 4% and above. Where we were at what? 0%, 1% for the majority of it. But everything's 10 years and below is what they're doing right now.
Yeah.
And you are seeing cracks in the armor. Look at, we had talked about commercial real estate, intensely for months. And was it Blackstone's property in New York City finally sold for 25% of what they bought it for?
This was their corporate headquarters that they were okay with letting go into foreclosure, as they talked about how they were putting such a large amount into buying properties. But they were foreclosing on their corporate headquarters.
On it. One in San Francisco just went for 20% of its high price. And then it's hit in Orlando too. Yeah. One of Orlando's properties sold for was about 30% of its peak value.
Yeah.
So we haven't done it in a couple of weeks, gone into the commercial delinquencies, which are through the roof right now.
Mm-hmm.
And you've got articles out there that, hey, probably 300 banks are going to fail over the next year.
300?
300.
We don't have that many. I know
I know there are that many left.
Like, it blows my mind that there's 300 banks. That there's 300 to fail. How many are left after that? Like 1,000 still? I don't know.
Yeah, I don't know. It's absolutely astronomical. So, but let's hop into ours, because this was actually nice to see this week.
Okay, let's see. Good news.
This was kind of pleasant. We actually jumped up to 538. We broke the 500 mark in sales in Orlando, which we haven't seen that in a year and a half, somewhere in that ballpark.
Mm-hmm.
So that was nice. And at the same time, our inventory continues to grow. So we're up 55 in the inventory. So what does that mean? It means we actually put more houses on the market than we actually sold at that high level, which is great. And I think this is where I think people have just finally hit that point is, okay, I've waited. Mm-hmm. Jerome came out. Jerome said, guess what? We're not cutting. We're holding steady. And people, I really think people kind of got that feeling of, screw it. I can't wait any longer. I've waited as long as I possibly can. I've got to sell this house. I've got to start getting it on the market. Yeah.
Okay. Yep.
And you're hitting, we just finished up our school this past week. So you've got all the families who are done with school, and the next couple of months, that's the time when they want to buy a house and do their moving before the next school year starts.
Yep.
Then for our condos even took a spike. We jumped up to 180 with the condos.
Okay.
Which is kind of nice.
Okay.
And then we're getting into our monthly inventory. Our months of inventory actually dropped below 3. So it dropped to 2.62. So that means the houses were selling faster. But our original list, the sales is still holding at that 95%.
Okay.
Right there. And same thing with the final to list, holding that 97% range.
Okay.
And our days on market's holding steady. So our market's holding steady, even though we saw an increase, the market's holding steady overall. And then you can see right here, here's our spike in weekly sales, which is really nice to see, 538. Because we are in the spring season, you expect this number to shoot up. I would love to see this pop above 600 for the next month and a half. That means we're actually having a very good, spring, summer season overall.
Yep.
Then you see here, our average inventory, we're up about 12% since the beginning of the year. That's a good solid increase in the inventory. And we broke that 6,000 level.
Okay.
Which we haven't seen that in 3 years.
Yeah.
Easily 3 years. And then in the condo market, we actually did the same thing. We had been up to about 4.5 months of inventory, and we actually broke below the 4. And then our original list, again, holding that 95%, final 97. Our days on market actually increased a little bit.
Okay.
But that's understandable just with the condo market. So Orlando last week, and I actually all of a sudden Friday, everyone and their brother called. Hey, I'm ready. Let's get this listed. Let's just get this done. All right, we're ready to look now. Mm-hmm. So I've been going, I've been going gangbusters since Friday.
Yeah.
Clients I stayed in touch with, I really do think a lot of them. And I'm thinking, what could have triggered this? And the only thing I could think of that triggered it were all the headlines that Fed's not going to cut. Fed's not going to cut. This rates are going to hold pretty steady.
And it's like you said, so many people have been on the sidelines for so long because what has been everybody has literally thought this, oh, wait a little bit, rates will go down.
Yep.
Oh, wait a little, home values are going to go down.
Yep.
Oh, wait a little bit, rates will be back in the 4s and home values are going to go down. Like people have had this notion in their head for 2+ years that we were going to see everything drop, value, everything, and we haven't seen it. And at a certain point, people go, wait a minute, like I was going to buy something 2 years ago, and now it's 5, 6, 7, 10% more expensive. Oh, and the interest rates are 4%.
And the interest rates are higher than
that. If I keep waiting, what is it going to be?
Yep. And that's really, I think, the sentiment that we've got out there right now is okay, I'm done. I'm done waiting. I'll work it so that, down the road, I am going to probably refinance. What's interesting is the refinance numbers are up. Even with the higher interest rate, refinance numbers are up. Which kind of goes back to our old, people are tapped out, tapping into their equity.
Yeah. I mean, we don't see rate and term refinances anymore. We see HELOCs and cash outs.
Yeah.
That's all we like. And cash outs are to pay down debt.
Yep. Consolidate, pay it down so I can run it back up.
Yeah.
How many times have you seen that? Yeah.
I have 1 or 2 clients that I can say religiously, they'll call me every other year because they'll be like, all right, I want to pay off this debt, and we'll pay it off. And then they'll rack it up. And then 2 years from now, they'll be like, okay, I need to refinance again. I can't that's their plan. Their financial plan is use my equity to pay down my credit card debt so I can reuse my credit card debt.
Americans.
So,
we're a different breed.
Well, we just follow our government.
That's true. Great example right there. Wonderful example.
So yeah, good stuff.
All right. Well, thank you everyone for joining us. And please like, subscribe, and join us every Thursday. And have a wonderful week. To all the moms out there, have a wonderful and blessed Mother's Day. Take care.
All right, Rocket.